Shashank, it's a pleasure to have you with us. How have you been?
Thanks, Ashu. Thanks for inviting me, and an absolute pleasure being here. And looking forward to the discussion. I'm doing very well, and wishing the same at your end.
Well, I think all of us are trying to keep safe, trying to stay indoors, and I think that's become the new normal, right? Optimizing around it, right? Shashank, this is a discussion I'm particularly looking forward to, right? It's always talk to an investor and know their side of the story, right? Unfortunately, this is one sector, uh, which is talked about less, right? Which has so much more insights, right? And I think that observation brings in a very different kind of sense when you're viewing an asset, right, from an investment standpoint, right? And I think there is a huge narrative which is around the economy, right? So I'm particularly looking forward to this discussion that we're having today. But before we dive into that, why don't you take us through your professional career? I mean, you've had a fledgling professional career before you became a full-time investor. Tell us a little more about that.
Sure. So I've had a very non-linear career path. I did my engineering and completed it in 2003, and then I went on to do odd jobs in mid-sized companies, beginning my career with the Gujarati Polyfilms Limited company, to
Right.
moving on to Zensar Technologies, then NIIT Limited in New Delhi,
Sure.
before I landed up doing my MBA from IMI New Delhi.
Right.
And this is way back in 2009, when it was not the cool. It wasn't a cool thing to join a startup post your MBA, and that's what I ended up doing.
Right.
In 2009, I became the founding member for VC Circle's SaaS platform called
Right.
VCCH.
Right.
Very, very thankful to that opportunity I received. Just completely changed the paths, and spent a lot of time in the growing PE/VC industry way back in
Right.
2009, which was really emerging.
Right.
Got to learn a lot, and we were also fortunate that the company reached a scale and point that it got acquired by News Corporation, so
Right.
saw that journey. And since we had a vantage point of providing data and research to this
Right.
evolving community, post the acquisition, in 2016, I decided to dabble with direct investments,
Right.
and hence I moved to the investment side. And in 2019, along with my other partners, Sanjay, Ninad, Yagnesh, and
Right.
Vatsal, we launched 100X.VC, which is an amalgamation and accumulation of all our personal experiences and understanding the challenges in the startup ecosystem, and our
Right.
attempt to kind of address it in a more systematic and structured way at the
Right.
seed level. So
Right.
that's been a quick journey. Very non-linear. Started as an engineer,
Sure.
was selling databases to the venture capital private equity industry,
Right.
and thankfully India has given this opportunity to the whole ecosystem, where we're seeing a lot of startups. So this is our attempt to kind of come in, plug those gaps, and
Right.
that's where I am right now.
I think that's very interesting, Shang. And I think I've had a similar path career wise, right? But I think with the kind of experience that you're talking about, right? I think you're very uniquely positioned the way I see it, right? To understand transition, to understand. I mean, India is like half of India is operates in a very traditional way, and half of India is we are kind of the way we are, right? We're mobile first and so on and so forth, right? And I think there are very few people who are uniquely positioned to understand both of those Indias, right? So I'm sure the kind of experiences that you've had in your career really help you understand markets in a better way, right? And in a more granular way, and in terms of their behavioral aspect and stuff like that.
Hope so. I hope so.
Interesting. Shashank, 100x is it's kind of changed the way early stage investing has been looked at, right? I mean, it was happening the way it was, but I think you kind of changed that entire thing, right? I mean, you introduced 100, you introduced safe notes, a very different concept which didn't really sort of exist. I think you've been talking a very different language, right? Tell us a little more about 100x, and instrument that you have in place,
Sure.
and your investing philosophy.
Sure. So, Ashu, as I mentioned, all five of us come from different vantage points,
Sure.
Sanjay, Ninad, myself, Yagnesh, Vatsal, and obviously all of us having dabbled with the early stage ecosystem and early stage
Right.
investments in our own personal capacity also. We realize that
Sure.
India is going through an interesting phase,
Right.
where possibly now, and we firmly believe that India is at a point where possibly Silicon Valley was in the 1970s and China was in 1980s. And the only way to kind of accelerate the process is if you can we saw, and as I mentioned, we saw the advent of private equity funds from 2008 and 2009. We saw a lot of heavy transactions, upwards of 5 to 10 million USD happening in India.
Right.
And then slowly and steadily, you've also observed that, we've had pre-Series A funds, emergence of other smaller funds post 2016.
Right.
And the check sizes are reduced.
Right.
But there is still a huge challenge at the bottom of the pyramid, where early stage entrepreneurs who are just venturing out and they're wanting to raise their capital. The duration, the time taken to raise that seed capital, even from the folks who've shown interest to invest, that was a challenge. And then obviously, the other nuances attached to it in terms of how do you value a company? Am I really supposed to value my company right now? I just need money so that I can hire somebody to build my product or start building up. And we saw a lot of good opportunities over here. And not only us, everybody understands is that number of startups are coming around, but their failure rate had not reduced.
Sure.
And hence, as a model which we felt was that, can we become a discovery fund for pre-Series A and Series A, which is a function of not your typical VC model that you make 5-10 investments a year, but it's actually a function of making 100 investments a year. And that's how we started out. Can we do 100 investments a year? We've not done 100 till now. It's been 2 years. We've done 50, but the objective is to reach 100 per year. And within that, if you can ensure that the average time spent or time taken to deploy capital and X amount can be done within 15 to 20 days.
Right.
Evaluation, due diligence, wiring the money, and then working with the portfolio company, right? It was the key. And I'm glad to say that we were able to kind of figure that out. We typically invest in our portfolio companies within 15 to 20 days.
Okay.
And the iSafe is a document which is, it's an instrument which has been used in the Silicon Valley by Y Combinator, and it's a much condensed version in context with the Indian laws, and a much condensed 5-page document which really helps founders raise capital quickly and for the investor to wire the capital quickly without actually assigning a valuation or going through a shareholders agreement. And also very founder friendly from a perspective of investors don't hold any rights, don't hold any board seats, which is not the intention when you're putting in the first check. And that's where we are. We are the first check into the company. So that's why iSafe made a lot of sense. We are the only fund which is doing investments through iSafe. And that's also because we are a fund which is much lower at the pyramid structure, right? And that's where we want to be, because the objective is to become a discovery fund for pre-Series and Series A, where SHA or a shareholders agreement makes sense.
Interesting.
So that's how the genesis of 100X came in. We saw an opportunity. We saw multiple incubation centers, accelerators come out with a lot of startups. We've been speaking with a lot of entrepreneurs and great founders who are attempting or have built out great products. And those are the ones we want to work with. Companies or founders who are at a minimal viable product or a proof of concept. Not typically idea, because we're not an incubation center, but really, really early ideas, get our hands dirty, pull up our sleeves and work with them by providing them seed capital.
That is amazing. That is amazing, Shashank. Shashank, tell me this, right? So, I mean, I have an additional question on the iSafe structure, right? So, is this like a completely open structure where only the next round or the consecutive round defines the pricing of your investment, or is there a floor or a cap that you work with? How does that work?
No, so it gets converted whenever the price round happens, right? And that's when it happens. And what it really helps is that founders don't spend time going through an allocation of an equity, which is again a function of assigning a valuation, which should not be the case in early stage companies. And helps the founders raise this capital very quickly, and the equity gets converted to a future round. And the incentive on both sides is that 100X or institutions who are working with this instrument are also incentivized to work very closely with the portfolio companies to ensure that they are metric driven, so that they're able to reach a price round, which not necessarily will be the next round, could be a third round, right? So, and it continuously helps founders raise money without assigning a valuation, without diluting equity, without going through the time frame of an SHA.
Right.
And the challenge of an SHA for an early stage founder is if it takes 60 days to close, it doesn't make sense. If it takes 90 days to close for a small amount of 25 lakh to 50 lakhs, you're wasting too much time and energy.
Right.
So it is to address that point. Yes, and the brilliance of the iSafe is that it gets converted whenever the price round happens, and then that's when the allocation of equity happens, which is working for many companies. In fact, companies who we did not invest in, or maybe who were looking at raising a larger round from other institutions, ended up using our document iSafe, which is open source.
Right.
And we are seeing a lot of founders kind of use this instrument. Not only founders, we are seeing a lot of angel investors kind of use this instrument to kind of get into a company quickly and kind of provide their capital without the hassle of structuring a very complex deal and spending a lot of time around paperwork. So that's where iSafe fits in, and we fundamentally believe that this is, whether you call it iSafe or you call it whatever, but this instrument which is reducing the time, delaying the equity conversion, and not allocating it upfront, hence not allowing a valuation round to happen right now for very early stage companies, is what India needs right now, because we've got a large set of entrepreneurs who are building out something interesting. They just need the capital quickly and let it become more valuable for it to be valued, is the concept.
Understand. Shank, is there an exception to this, right? So, for example, say you're looking at a company which you're interested in. Of course, you want to sort of do a transaction. Are you kind of open to collaboration? Have the rounds been bigger? For example, typically your transaction, or you typically tend to come in at a point where you're doing it by yourself, and then of course others who want to come in and participate can possibly come in and do that, say with a certain lag, right? Is that how it works, or do you?
So we don't co-invest. We are the first institutional check in our portfolio companies, but what we do is after we invested in them, we work very closely with our portfolio companies, and we do this in classes. Class 1, class 2. Class 01 saw 20 investments. Class 02 saw 9 investments. Class 03 saw 10 investments, and class 04 saw 11 investments. So we'll do investments in a number of companies at one go, and then we'll spend time getting them more metric driven. So this is where all the 100x partners networks comes into place, which our portfolio companies can leverage. So let's say we work with 300 plus CIOs, and if I have let's say 5 SaaS based companies in my portfolio, in our portfolio, how can we help them get more metric driven by ensuring they get certain business contracts through our network, whether it's getting a top down approach. That's the second piece. And then obviously getting them ready for the VC pitch day, which has now become the mecca to source early stage investments. And the reason why I say this, because our last 2 VC pitch days saw our portfolio companies, and they were oversubscribed by investors within 10 days, right?
Wow.
And we saw the participation of institutional investors, and many of the large VC funds who've invested in our portfolio companies, to angel networks, to HNIs, and to family offices. And that's the space which we wanted to kind of bring about. Once we've done this, that's the stage where other investors can come in and invest into these portfolio companies.
Interesting.
But we want to build it up for them, and then so that eventually these companies never had the chance to get viewed by a typical growth stage VC. Right. But the kind of work which has been put in by 100x, they have now become more metric driven and more there's a readiness for them which is perceived by a growth stage VC. And as I mentioned, I come back to the same point. The objective is reducing the failure rate of good companies, because they weren't able to kind of A, get access to capital, B, get access to network, and C, work practically ground up, and become more. So and as a function of that, create a larger pipeline of companies for pre-series A to series A. So that's it. So we don't co-invest because the model is very, very different. But we open it up for every other investor at a VC pitch day.
No, I understand that. I think that completely makes sense, right? I think you're not looking at it like a like a typical investor, right? Or a VC investor, right? You're looking at it in a very different way. Your role is very different, right? You're
Correct.
into a more functional role where you're
Correct.
saying, listen, this is a good technology. We're going to bring it on our bench. We're going to work with it. We're going to shape it up, and then we're going to take it. Like Shashank. My apologies, Shashank. You take 2 batches in a year, right? Typically,
So
what is the process of that?
So yes and no.
Right.
We started in 2019 with the
Sure.
objective of investing in 100 companies a year, which
Right.
could be 4 batches a year,
Sure.
20,
Oh,
25,
interesting. Okay.
right? We did 20 investments in September of 2019, which we
Sure.
announced in December of 2019. This is
Okay.
pre-COVID. We saw 300 plus investors at IIT Bombay.
Right.
IIT Bombay and the Sign team over there was kind enough to partner with us, and we were able to kind of use the venue. Amazing location.
Right.
And then we were getting geared for our next batch, which we wanted to possibly invest in by March, April.
Sure.
Again, would have been 20 to 25.
Right.
COVID happened, and we were new fund, and we are still young, right? And we wanted to understand. We've not had much
Right.
experience in running a proper fund, so
Right.
we decided to kind of focus on the current set of investments and ensure that
Right.
with the seed capital, how are they going to perform or survive
Right.
over the next few months, and that became a priority.
Mhm.
So we worked with that. We ensured that the agenda was, can we help them raise more capital, and
Right.
we were able to kind of help them raise significant capital up till May of 2020, when
Interesting.
the entire market was not doing well in terms of sentiments.
Right.
And that's when we started scouting for the next opportunities. So hence there was a shift in the strategy where we still want to do the same thing, but
Right.
it wasn't based on, okay, we need to do 4
Sure.
set of batches or 5 set of batches or 3 sets. The objective was, whatever investment we do,
Right.
the success rate needs to be really high. So
Makes
even
sense.
if we invest in 5 companies, we need to ensure that these 5 companies are growing. Hence,
Right.
with that thought process, we only invested in 9 companies in
Okay.
class 02,
Right.
which was in August of 2020.
Right.
And when we invested in them, we realized their progress, and we understood how the market is evolving during COVID, which
Sure.
models were emerging.
Right.
That gave us also confidence as investors, and seeing growth stage investors react to certain of our portfolio companies.
Right.
We went ahead and did another set of 10 investments by November of 2020. So 20 investments in 2019, 19 investments in 2020
Right.
cumulatively. And then obviously, we've now made 11 investments in March of 2020. So hopefully by end of next year, we should be doing at least, if not 4, at least 3 set of classes, which
Right.
should on an average have 10 to 15 companies.
Interesting.
And because this is all now happening virtually,
Right.
very different from how we started and launched, and having founders come into the office and all of that. Very different mechanism of investments, very different mechanism of evaluation. But again, the goal hasn't changed. We want to have a portfolio size of 300 to 400 portfolio companies over the next 2-3 years, and continue to kind of provide discovery opportunities for pre-series A to series A funds.
I think, Shashank, like you said, and I completely understand that. And I think the fact that you've still been able to keep the momentum is fantastic, right? Because the stage that you're entering and the kind of capital that you're entering is it can move the needle to a certain extent, right? But of course, a high growth business requires more capital, right? And I think 2020 has been a very disruptive year in its true sense, right? I mean, of course, we've had losses at a personal level, but also the fact that the industry has gone through a paradigm shift, right?
Correct.
We're looking at a different kind of a consumption model which is going to come in, right? And I think I personally believe that I think this is a phase which is only kind of improve the complexity of how we're going to shape up as an economy, right? Because I think our the kind of influence that we're going to have on us as consumers is going to be so much more dynamic, right? That our preferences are going to shift, right? Which essentially means it's going to get very complicated for investors to view an investment and see a maturity of 4, 5, 6 years, right? Because there could be a possibility that fad could say exhaust in a matter of 18 to 24 months, right? And I think that could be a very strong, complex problem to deal with, right? So I completely understand where you're coming from. I think gauging what you want to sort of be in, and and I think trying to sort of have a thesis around it has become difficult during this time. And I think we'll possibly continue to be in this zone for a reasonable amount of time, right? Shashank, my next question is that take us to the portfolio. You had some interesting companies in your portfolio. You're agnostic. You're, I think, sizing the opportunity as it comes, right? Take us through your portfolio. It's a large portfolio that you have. Which are some of the companies that you've been particularly excited about? Give us a sense of the kind of growth that you've seen, say, since you've invested in them.
Sure. So, very, very sector agnostic. We've invested across categories. We are current portfolio sizes of 50 companies. We've invested in agri-tech, B2B, B2B2C, deep tech, SaaS, deep learning. EdTech has been a very, very interesting segment within our portfolio companies. Social commerce, vertical commerce, and all of these companies have been, amazing. In fact, to the extent we've invested in a chocolate brand, we've invested in a chips brand, and also, ventured into the consumer package space. And it's a brand called Kerala Banana Chips.
I love them.
Yeah, and yeah, we've also gone ahead and invested in companies which are not sexy from a VC standpoint. A company called, companies like Renal Project, which are providing dialysis, very asset-light model, and converting existing clinics in suburban areas, and providing, dialysis center for 1,500 rupees. No technology, just pure execution game. And mass reach out, right? And we've gone ahead and invested in that kind of company. They're doing very well. They've raised a larger round. Some of our portfolio companies are now reaching a Series A. Hopefully, we'll have some announcements coming our way. But yeah, we've had our objective when we're investing in a company is, we are investing through safe. We don't have any stake in the company. The risk is on our side, and the objective is that our only exit model is whenever the company's reach a Series A or a Series B, and that's when we'll take an exit, which is at least 3-4 years journey. And what we look when we're looking at a company, some of this might be cliched, everybody's heard of it, but really at this point of time, it really boils down to this. At the stage we look at, founding team, we look at the complementary skill set. It's very, very important to see the team dynamics, more so because you're investing in some sort of tech-enabled companies these days, right? So do you have an individual as a co-founder who understands this space? He might not be or she might not be the business person, but somebody who can leverage and understand technology and kind of continues to build on that. So, so team dynamics, complementary skills is something which we really, really look at. And second, obviously, is our assessment of the opportunity, and not as of today, but what it could be at least 5-6 years down the line. And again, not always very easy for an investor or for a founder to kind of determine that. But then that is what this whole game is all about, right? You're trying to understand what could become big. So we try and look at that, and obviously we look at the founder's ability to kind of build, or his attempt or her attempt to envision a business model. So if you've identified a large market, have you figured out a business model within that piece, which is not going to work only for 6 months, but have you figured out some long-term strategy? I'm not saying you've figured out all the pieces, but really the 3-year cycle. And that goes on to the see, all these attributes will help us understand, are you looking at this at a long-term building cycle, or are you building a lifestyle business? And then obviously, is there an IP, or is there a moat? Is there first movers advantage? So for instance, we're building a horizontal commerce platform. I'm not very interested, but we've gone ahead and invested in a company named Cora, which is a vertical commerce for healthcare product, right? A huge opportunity, and they've gone ahead and raised capital. So these are some of the things which we look at, and then most importantly, because we are investing through iSafe, and eventual round will get converted only when they raise a price round, which is a function of performance. Hence, it's very important what value can 100X bring onto the table. Can we really help them grow? Can we really help them scale, despite the fact they might be on a paper, they might be a high growth idea. So that plays a very, very important role. And can we help them grow in the short term? 60 to 120 days. Can we really kind of help them accelerate to a point where they are becoming more metric driven, they have a solid pipeline, and they're able to raise the next round?
Shashank, can I tell you something? I think you've chosen a very difficult path for yourself, right? I think in a market like India, I run an accelerator.
Yeah.
And it just takes a very different kind of an energy, right, to business in that duration, right? It's a very, very difficult path that you've chosen, right? And I think your risk is added because you're literally sort of entering a company when it's in a very, very formative stage, right? It's a very, very difficult path. And of course, while we're discussing the portfolio, while we're of course discussing how you select a company, there's always an anti-portfolio, right? And I think that's and I think I'm sure, and the list must be long, right? I'm sure with COVID, all of a sudden businesses that weren't, say, all that nice and sexy in the way we were operating in 19, all of a sudden picked up steam, right? And they were the talk of the town, right? So what's been your say some of those misses?
So I mean, from a 100x point of view, it's right now early to say because even the ones which we've invested in are still growing. They haven't reached a Series A or a Series B right now. So I really can't talk about the companies which we did not investing in because they also going through the same journey of and they possibly will take another couple of years to reach Series A. But what I can personally talk about are a personal angel investment opportunity which I really missed, and that was an anti-portfolio. And I've talked about it publicly. Also, I've written a blog, and it's a company which I was evaluating through one of the angel networks which I was part of in 2018. I still continue to. I've done 2 investments from that particular network, and great team, great founding team, great backgrounds, IITs, and experience of having built and sold a company. And during our interaction, I was supposed to be leading that transaction at the angel network. As you've got one lead investor leading, and I was trying to convince all the other angel investors, this is a great company, invest and all of that. And we spent 6 months just kind of figuring out. We got them certain opportunities to kind of push and sell their solution. And what we realized is that they didn't want to sell, and they had a mindset of they built a company and they'd sold it to Naukri.com. And that's what they had in mind. I said it won't work till the time you sell. And I decided not to lead the round, not to invest. Lo and behold, within 10 months, they got acquired by Haptic, Reliance, at a significant value. So we would have, all the angel investors would have made, significant capital in that short time. But what I'm trying to say is that I learned a lot during that process, right? While an investor might think on a certain path of a journey for a company, but sometimes a founder has a fixed mindset, and I would have never thought that a company would go and acquire. The real question is it the right path to get acquired? But then, if you're building out something which has a larger use case for a larger organization, that too works, right? From an investor mindset. Absolutely. So that was a huge miss, and that gave me a lot of learning. And I'm sure at 100x we will have our own stories, but right now it's a little too early, frankly speaking. But yeah, I'm sure we will have many of them.
Interesting. And when you say that, and I hear you, right? I think it's a lot about the founder's mindset that one has to sort of deal with, right? And this is a very cliched question. I'm sure you've answered it thousands of times, right? But what are some of those things? And you've highlighted in one of the questions that you answered earlier, right? Or what are some of the things that you look at, Shashank, right? When it comes to the founder evaluation, because I think that's the only constant. The only constant when you're evaluating a business is the team, right? I mean, the systemic issues will continue to arise. There are things, the policy issues will continue to arise, and there are certain things that you really can't do anything about, right? But the only constant is a team, right? So what are some of those things that you look at? What are some of the traits that you look at, right? Is, for example, also an IIT IIM something which has been, debated, deliberated, defended across the board? Is that still relevant, right? Or are we in a very different, zone of operations now?
So I'll break this in 2 points. One is obviously, I've mentioned the 5 points, but over and above that, I think founders and business model and total addressable market and unique mode. Sure. I think one thing which we try and evaluate is most critically, are the founders building a lifestyle business, or are they building a business which is going to scale? Because if they're walking the path of raising capital, then they need to be sure that they're going to be walking on a treadmill for a very long time, and they need to continuously raise. So that's a mindset which we try and gauge over our discussions and multiple discussions. To answer your point on IIT IIM, I think those founders still build out great businesses. There's a discipline, they have a mindset. The IIT is the bits. no doubt about the kind of businesses that they're building out. And yes, they are definitely a preferred category, no doubt about that. I won't shy away from that. That being said, the whole ecosystem has evolved, and we are seeing amazing businesses being built out from regional engineering colleges, pedigree background, from founders who've quit their colleges. We went on to back something which did not fall under our thesis. We ended up backing a single founder, college dropout, had built a great product. And we thought, okay, I think there's a lot of potential, we can help him grow. But within 90 days, he got funded by another VC fund, which was a validation that the models are changing, the models are emerging. IIT, IIMs, and good pedigree founders, yes, will continue to get funded, and they are going to continue to build businesses. But for the first time, we are seeing entrepreneurs from various other backgrounds come in and being successful in raising capital. So we have no bias from that perspective. We are not evaluating companies from that perspective. Even when you're evaluating founders, we're not looking at the pedigree, we're looking at the compatibility in terms of business functions which they'll be looking at. That's my 2 cents on that.
Shashank, very interesting. I think another thing is that you've been in this ecosystem long enough, right? I mean, I've been in this ecosystem long enough, right? When we look at founders, that came, say, to raise capital, and being a 20-year-old was extremely sexy, right? When you were out there to sort of raise capital and stuff like that, right? And there was a very different narrative which was set out for the industry, right? I think there was a very different kind of an image that was which was kind of celebrated, right? Today, I think it's very different. I think a founder has evolved, right? I think 2020, what it has also done is that it's made a lot of professionals look back and saying that, listen, I have worked long enough, right? There's something that I've been able to achieve, and there are certain things that I would want to do independently, right? So I think we're kind of seeing a huge surge in very mature founders coming in. I mean, if you look at fintech, right, average age is not going to be 22, but say a 33 or a 34, right? And they come with a certain experience and stuff like that, right? What are your thoughts around that? I mean, what are your thoughts around that evolution, right? Is this, does this shift bring in a certain consistency to what we're going to see in terms of, say, failures as we go along? Because the orientation is very different. The understanding experience. Right? What are your thoughts about that? Right?
No, I think that is happening on ground, and I think it is a good thing which is happening. As I mentioned, when in 2009, when we at VCCH, when we were pitching our product, we were encountering a lot of private equity funds as opposed to growth stage VC funds because they weren't in this ecosystem. In 2015, we saw a lot of micro VCs emerge, right? And similarly, we're seeing the next stage of founders, their second entrepreneurship gigs shaping up. Founders who started their gigs in 2009-10 have sold their businesses, scaled, and now moved on to second ventures. And this is a very, very important timeline to be happening in 2021 from a standpoint of having seasoned entrepreneurs, because there's just so much plethora of information which young time entrepreneurs can not only acquire from a business standpoint, but also the kind of mistakes which can be avoided. This is exactly the inflection point which most of the other developed and evolved ecosystems have seen. This is a very, very good sign. Yes, and this is happening right now. And I am glad to say that I'm looking forward to the fact that going forward, you'll have at least 50% of investment being done by all investors in second-time entrepreneurs. Now, even if you look at the US evolved ecosystem, a third-time entrepreneur who's possibly at the age of 40, 45 still goes to a Y Combinator, still goes to an early stage fund to get that validation to get funded. They've made enough money. They can self-fund their business, but they understand the value of institutional capital, right? And that mindset, they still go through the entire model of being mentored or guided by investors, having them open certain doors. And that mindset is now slowly and steadily come into the ecosystem. You've got the likes of Kunal Shah, you've got the likes of Jitendra, who started their second ventures now, and they've been funded. And they continue to leverage, the likes of Sequoia's backing to kind of understand how they can continuously grow. And this mindset is very important. This will inculcate a thought process in the founder's mind to kind of aspire for the highest thing. Right now, what I'm seeing, unfortunately, and I can say this on direct forum, I'm not shy in saying this in any of the forums, that currently founders are still intimidated by the investor community. Now, how do we go about writing a pitch deck? How do we go about approaching an entrepreneur? If you're still asking those questions, you're late. You've got everything online right now. You've got all the repository. You need to continuously move to that next level and think of, getting the investors' attention on the next level, right? I'm seeing a lot of these basic questions still. There's a lot of hesitancy of, jumping into something when you've already started. And that with the advent of these seasoned entrepreneurs coming in and with investors aggressively scouting for more deals, that mindset will evolve. So it's a very, very good sign.
Very interesting, Shashank. Shashank, what are some of the emerging areas that you are particularly excited about? I am particularly a fan of what's happening in agri-tech, what's happening in fintech, what's happening in D2C, right? What are some of the emerging areas that you are kind of excited about, right? And you believe that some of your major investments are going to happen in that area. I know it's a difficult one, but broadly is what I want you to sort of answer this particular bit.
Sure. So, I mean, we've invested in what we feel an interesting bunch of folks, and, we've done deep tech, we've done SaaS, and some very interesting companies, which I feel, sectors which I feel are emerging. Obviously, for example, we invested in a company, we've invested in EdTech, but, we've invested in community-driven platforms of EdTech, and we've invested in a deep tech company, which is doing auto grading.
Right.
For of assignments, any kind of assignment, right? And it's possibly they've only got one possible direct competitor, which is based in US, right? And it fits into the whole ecosystem, right? They're not selling a service. They're not saying online coaching. They're doing something very important within the edtech. So if they're able to plug in that piece, the whole edtech space is evolving to a different level, right? So when I say edtech, it's not from a cliche perspective. EdTech is actually going through a very interesting pivot right now. Remains, a focus area. SaaS businesses, for the first time in India, have gotten their fair attention. We still deserve more attention. And I feel it is, and the Indian corporates' mindset to buy from Indians, I think that is a huge market. Also, you need to understand, and you'll appreciate this, Ashu, that with those second-time founders coming in, we are also seeing startups which have now become big Indian corporates, so to speak, after 10 years, right? So you've got the large MNCs and you've got these growth stage, massive startups which started 10 years ago. And they are also clients for many of these SaaS companies, or many of these early stage companies. And that ecosystem is evolving. So very interesting time for SaaS businesses to be grown and build, and also identify a certain set of buyers in India. While the argument still remains that US still is a large market, it always will be. But we're talking about how India is slowly becoming a market where you can continue to sell. So SaaS businesses, edtech, agri-tech, definitely interesting. Social commerce platforms, right? The whole way we communicate, and at least you and I'm 40, so they say I've moved into a different generation, and
that's the new 20, by the way.
So, but the way, and what we do is we have 5 partners. We're a very small team, but we work. We run a 6-month internship program, and they're only of 3rd year and 4th year students. They work with us for 6 months. And they think that they're learning a lot from us, but what's happening is we are learning from there, because it's so important, because the whole generation is in that age, and the buying patterns, how they communicate, how they socialize, everything is evolving, right? And the pulse of the market is quite different right now, and hence we've invested in a few, two social commerce platforms, and the whole community development and the developer community on the development DevOps side is a very interesting space evolving. But again, as I said, I can't pinpoint any one sector, because for me, it's an open canvas right now. Everything is up for grabs in India. Every sector has a potential. I'm seeing a lot of growth stage VC funds retweak their business model, or rather retweak their check sizes to try and figure out how they can look at early stage opportunity, because everything is evolving. How this might evolve into, I don't have an exact answer, but obviously we've got the right trends or indicators. For instance, cheaper data, everybody working from home now, mostly, everybody deeply connected. For the first time in generations for a developing nation like India, our bosses, if I'm an employee, my boss is quite comfortable me working from home, and he's able to manage me. Right, that trust factor. I don't need to be in office. That cultural mindset is happening, and hence, as a function of that, you've got HR tech platforms evolving. You've got remote management systems evolving. Larger organizations saying 10,000 employees will not be working for the next 2 years in office, right? So how do you manage? Field force management softwares are for the first time getting more traction. How do they continue to manage? So the whole ecosystem is evolving, and is pushing in requirements for these newer tools, which are likely going to be part of the way we buy, sell, communicate for the next 10 years. And hence, from a broader perspective, clean tech, EV, and we've done an EV SaaS investment to, industry 1.4.0 will, a lot of SMEs and MSMEs are now very open to adopting sensor-based technologies for their own equipments and monitoring the machine downtime, because now in COVID, they weren't able to have many employees come in, and they were forced to kind of go digital and consider themselves as digitized. And those things are emerging. So it's a function of putting your, increasing the speed, going in the fifth gear, and just kind of exploring. And at 100X, we are very, very open to any sector, as long as it's asset light. We are a small fund. We're a micro VC fund, which is doing small ticket size investments in many companies. So we will not be investing in a manufacturing plant per se, or a large asset light model. Models will have to be asset heavy model, but for us, models will have to be asset light. And for that, we are open to any sector. As I said, our objective is, we're still discovering, some of the sector which I was not looking at last year, I'm looking at this year. My personal growth over the last 1 year in terms of how I look at sectors is still evolving. And to be very honest, it's not the investors who know best which sector is evolving. It's till the time we speak with founders, you're like, oh, you're doing this sector, right? Oh, okay, this is interesting. So it's actually the founders who are driving this. And we are very open to backing companies as long as it fits our criteria of, can we add value in the short term of 60 to 120 days and help them reach the next round. If we feel that we can help open certain doors for a SaaS company and get them more metric driven, or a social commerce company, then I think it's a win-win situation for the founder and for us as investors also.
Interesting, Shashank. Interesting. I think I mean, I have like a bunch of questions in my mind, when I hear you talk about all of this. But before I dive into that, Shashank, Bharat has been talked about a lot, right? All of a sudden, I mean, this is a conversation that started with Geo, right? Geo came into the picture. All of a sudden, people had very cheap data plans in their hands, and they were exploring. They started to explore content, right? So the kind of exposure that people had at, say, the bottom of the pyramid, or say in a tier 3, tier 4 city, or a rural setting, right? It just exploded, right? And of course, a lot of that was, we could see the surge in, say, platforms like TikTok, Snapchat, and so many others, right? It just went through the roof. There were thousands and not thousands, actually, that's the wrong word, right? But say millions of creators who came onto these platforms and started to sort of create a lot of this content, right? How do you view that as an opportunity? Because I think everybody is kind of vying for that segment in the market, right? How do you see Bharat as an opportunity, right? While of course we are raving about the consumption that is out there, there's also a problem, which is that of low per capita, right? Which essentially means that there is lesser disposable income, which essentially means that there is going to be a certain shift when it comes to, say, purchases. So influence is there, interaction is there, engagement is there, but what are your thoughts around that translating into consumption? Right? I mean, how do you visualize the idea of Bharat, right, when it comes to growth in startups and and their contribution into the revenue lines of the business?
So when we started the conversation, I touched upon the point that I'm of the opinion, and I think many people in the ecosystem are of the opinion, that India is at a vantage point where Silicon Valley was in the early 60s and China was in the 1980s, right? So we've got the right ingredients. It's just a question of, are we going to make a bad dish out of it, or good tasty dish?
Sure.
And in terms of the average age of the population and the size of the population and the ability to reach this gentry and this set of people in tier 2, tier 3 is there, right? In terms of the geo access and the ability to use a cheap but efficient smartphone at rupees 5,000. Anybody has power today. If I have to prepare for a session, I'll review certain documents and prepare for it, right? An average 15-year-old student in, let's say, Chhattisgarh, who has motivation to review content for 2 hours and through his smartphone and prepare a session, has the same opportunity and possibly can do a better session. I'm just saying, right? So the opportunity is there. Now the real question is for us ecosystem players is, how do we figure that out? So obviously you'll find in terms of the creators economy, that opportunity, that's an open canvas. That is a huge opportunity. How do you monetize that? Those monetization models are going to come in. Nobody has the exact answers, but is the opportunity there? Yes. Are you going to see more consumption? Yes. But then that's where the question will do the tier 2 and tier 3 folks have the power or appetite to buy? Yes and no. Really depends on how they consume a particular service. But it really boils down. See, what has happened interestingly is that this is more from a startup landscape.
Right.
We had Bombay, Bangalore, Delhi, and again, this is very generic. There are no hardcore stats, and but it's a trend which is interesting to observe. With the Bangalore and these tier 1 cities being at the center of employment and center of everything, the last 2 years post-COVID, and obviously we had started seeing a little bit of trend of Indore picking up as a startup hub because of a lot of engineering colleges, my ability to hire a cheap developer, efficient developer at a lower cost at 15,000 rupees, as opposed to getting a Bangalore-based developer who's at 35. It's just efficiency, right? So the whole startup ecosystem was emerging from smaller hubs like Pune, Indore, right? That kind of accelerated post-COVID, right? Because of reverse migration, not only at the blue-collar workforce, but also for folks at who were hailing from smaller cities, and they decided, "Okay, yaar, वापस चलते हैं, काम करेंगे." And that actually has made a lot of difference when we interact with entrepreneurs in Indore or smaller city. They've decided that Chandigarh evolved beautifully, right? And these ecosystems are emerging. So how we are discussing is Bharat is we're talking about the other. Again, this is my perspective. I could be wrong. Just my thought. On one end of the side, you're saying Bharat and their appetite, and they might not be able to buy, or we might not be able to build out the right solution for them. And this is a huge lot. But we are only considering ourselves from a tier 1 perspective. There's a whole set of tier 1, tier 2.2, 2.3, 2.4 Chandigarhs, Indores, right? That gentry, within that we have so much opportunity. By the time we reach Bharat, right, if you're able to cater them, these ecosystems will build up. They'll start supporting their ancillary cities or ancillary smaller towns. So the opportunity, it's just about execution. That it's from the startup ecosystem, this change is happening. 100X is investing consistently, percentage wise. The percentage is increasing consistently, investing into companies which are hailing from tier 2, then tier 3, then tier 1, right? That change is happening.
And are these companies operationally out of functional out of these things?
Operationally.
And they're catering to those areas.
Yeah, and one of the companies which got funded by a very large growth stage VC fund, one of our portfolio companies, Class 01, was from Indore. Continues to be in Indore. Yes, because the fund is now based in Bangalore. They're expanding. They have one office in Bangalore because tier 1 cities will still have that attraction point. But what I'm saying is that the courage to start businesses, right, and courage to build out businesses, sell from those cities is there, right? So the traits are there. Again, I'm talking very macro.
Right.
There is an opportunity here. It just boils down to how we execute, how we build out, how we cover the gap between tier 1 and Bharat. Right. And there are multiple tier 2s here. How do we create those ecosystems? Because those will then translate into the hinterlands of Bharat, where the challenges still exist.
Right.
The challenges are immense, but definitely an opportunity. This is what China was able to do 20 years ago. And kind of, the average per capita income of an average Chinese in the hinterlands or outside of Shanghai and Beijing was just dismal. That ecosystem changed within the next 20 years. So we are sitting at something. I'm optimistic about it. Right. but again, boils down to execution.
Shashank, when I hear you, and I am just, I can imagine, what you're possibly, going through in your position, right? As when you have to invest in something, and there are so many moving parts, it's just so difficult. And I think the stage that you're entering is so early that you don't have a lot of these indicators, right? And, what do you sort of what do you bank on? What do you prioritize? I think it's just so difficult, and I can feel where you're coming from, the complexity that you're dealing with day in day out. Shashank, last question. We're towards the end of our conversation here. What are your four advisors for founders who are building, right? For India, which is in a very different, which is a very different opportunity. It's a massive opportunity, but it's also we're getting into a very complicated phase, right? What are your, say, top 3, 4 points that founders should look for when they're building out?
So I think my recommendation to aspiring entrepreneurs is no better time to build out than 2021. Today,
Right.
as opposed to the last 10 years, you've got access to folks like yourselves. You've given them the opportunity to kind of view content. They have the opportunity to directly reach out to investors who are actively scouting for deals. They have enough and more content available online to kind of learn the nuances of building a business plan, pitch deck, speaking with other entrepreneurs, because the second generation is now evolving, and most critically, not be looked down upon when you start a startup.
Right.
That mindset is changing and almost has changed, right? So
Right.
hence, you can't be scared of how people will judge you, because now you can afford to fail and start again. And you
Right.
talked about, oh, you failed, man, that's so cool, right? I mean, I'm just talking about the mindset, right?
Absolutely.
So there is no reason for entrepreneur. Again, I come back to the same point which I mentioned earlier, right? Some of the founders
Right.
still hesitant, right?
Right.
How do I reach an investor? How, right? I mean, the whole ecosystem is about investors,
Right.
and the whole the other side of the equation is changing. It's the
Right.
entrepreneurs who need to kind of just stop getting holding themselves back,
Right.
and they just need to kind of experiment. It's like the times are changing, and if you don't kind of experiment and try something out, 4 things will fail, one might emerge. And because this change is there, something amazing might just be built out, right? But you will never know till the time you haven't jumped in and
Right.
gotten your hands dirty. And that's my only advice to the founders, aspiring entrepreneurs who sitting on the sidelines thinking कि यार मैं 9 to 5 करूं या थोड़ा सा experiment करूं, यार मैंने
Right.
पढ़ा था आर्टिकल कि एक बंदे को फंडिंग मिली, चलो मैं भी करता. I mean,
Right.
either you build it out, you build that vision, and today is a good time because everybody's talking about it.
Right.
There are channels to learn. There are channels to understand and develop your understanding of building out companies and
Right.
seeking funding. Micro VCs, growth VCs. I mean, 2009 growth VC, micro VC. I didn't have any understanding.
There were 5.
See, it's right. So it's a great time to build out, and I think founders should experiment as much as they can.
That is a very relevant viewpoint, Shashank, and I completely buy that. Right, I think the time couldn't be sweeter. I mean, there was this statement that Kunal Shah recently made in one of his conversations, right? And he said that when you have so much money which is available, right? It's I mean, it's a phenomenal opportunity to go out and build, right? Rather than and not build, right, and be part of that journey where you're working for somebody, right? And I think I completely buy that point of view, right? I think the money availability is very different, and like you highlighted, right? Culturally, we've shifted, right, from where we were. Looking at failure was, there was like, it was almost like a placard which will, you'll have to carry with for your life of being a failure. But I think that has completely changed, right? I think there's this renewed acceptance which is there. People are more, more contributive. People around you are more contributive. They're very supportive. The VC ecosystem has come in. They're not, almost gods, which was earlier the case. But I think they've become friends in the process. A lot of conversations are possible. There's a lot of learning possible. So I completely buy what you're saying. I think these are very, very interesting times for anybody who thinks that they can start out. Should start out. It can't get sweeter and better than this. And I think it's a completely new open canvas, right, of a connected ecosystem, right, which otherwise was difficult when it came to India and to operate in India, right? But today, I think your customer is available in a digital environment, right? So you to go out and say engage is so much more easier, right? It's so much more transparent. I think that's something that founders or aspirants should utilize, right, even before they start to sort of think of it, right? Shashank, thank you so much. It was a pleasure to have you with us. Thank you for taking the time out.
Thanks, Ashu. Thank you so much. Thanks for inviting me.
Lovely. Bye bye.